2 of topic 3 case notes, so I just had to stop the tape there and make some adjustments. Right, so we went through the accounts, and we wanted to take a look at the financial position of the company from the point of view of liquidity, profitability, solvency, and efficiency. So our first port of call here is we will look at the liquidity ratios. Now, for the numbers that we use here, we will go to the income statement, we will go to the balance sheet. They'll give us numbers on current assets, current liabilities, and inventory. So the current ratio is the normal go-to ratio for any company, and we see that there we place our assets, current assets, which are at 2.3 million, over our current liabilities 1.3. So the idea is, do we have enough to cover our current liabilities? And you can see there that for every dollar we owe, current liabilities are money that is due to be paid back within the year. For every dollar of that, we have $1.77 in current assets. That is, we have enough assets that are easily enough transferable into cash to pay for that. So this is quite a strong liquidity position. Again, how it compares to its industry peers and how it compares against itself are matters for looking into if you had those figures available. But for us, for our intentions, we don't need to go as far as that at the moment. The quick ratio, well, we use the quick ratio when we've got inventory on hand that might be a little bit hard to shift. It might be a little bit hard to sell. Think, for example, the owner of a luxury car company. Okay, it's not every day that you have a customer walk in the door for luxury cars. So that person might want to take a look at their liquidity position when you take the inventory out of it. So this is the assumption that you don't sell the inventory. So here, in this example, we have 2.3 million. Minus out that $1 million worth of inventory. Again, we took this from the balance sheet and divided by the current liabilities. And here we have a ratio of 1 to 1. So for every dollar we owe, we can cover it with a cash or cash equivalent of $1, which still leaves us in a relatively safe position. So from a liquidity perspective, this company doesn't look too bad. Next thing we'll do is we'll take a look at profitability. So we have a number of figures to look at here. And the first is our gross profit margin. Our gross profit margin effectively shows us how profitable this kind of business is. Now, it doesn't really take into consideration the idiosyncrasies in our own business, like our wage expenses, our particular depreciation expenses, but it gives us an overall feel for how this business thrives. And we're looking at a 40% profit margin when we take our gross profit, okay, and we divide it by the revenue. So that gives us a 40% gross profit margin, and that looks fairly healthy for any kind of business, really. Now, what you want to see is a net profit margin figure which is not that far away from that figure. Now, obviously, it will be far away in terms of that. The gross profit margin figure doesn't take into consideration any of the expenses that we would have in operating the company. So if we look at our net profit margin figure, we see that it's the net income divided by the revenue. In this instance, it's $1,012,500 over 10 million. And here we have, we keep it to 2 decimal places, so we have approximately 10% net profit margin, which on the whole doesn't look too bad as against a gross profit margin of 40,000. So this again still looks like a healthy business. How it's doing compared to itself and its peer group is a further question we can ask. The last ratio, we didn't come across this in the class, we didn't include it in the class, but this one actually looks at the return on equity. We didn't include it in the last class example because that company was actually making a loss, so there was no actual return on equity to speak of. But here we are making a profit, and we see the net income as a proportion of equity is 1,012,000 over 4 million. And that gives us a return on equity of 25%. Now, that is the return going back to the investors. And an investment return of 25% is really quite decent. You'll find that you wouldn't find that looks like a pretty good year on the stock market. So it's quite a good return. Moving on, we can now look at the solvency of the company. So if we do that, we can look at the debt ratio. And our first port of call is to look at that capital structure. So looking at the ratio of debt to equity in a business. So in this instance, we've got equity of 3 million and we've got debt of 2.75 million. So effectively, for every dollar of equity, we have 78 cents of debt. Now, that in anybody's language is quite high, so it's something that maybe you would have a look around and see what your competitors are doing. You'd imagine that perhaps the company is in this position because it feels confident that it can avail of the prevailing economic climate, one where there's a lot of growth. You don't mind getting into debt so much, so that could be the reason. But what we need to look at as regards to this is its ability to actually cover the interest expense. Remember, if it can't cover the interest expense with the income that it has, then you can move into a sort of a problematic time, or you can move into a period of financial distress. And here, if we take our operating income and we divide it by the interest expense, we can see that that is a relatively healthy 14 to 1. Okay, so that means we can cover our debts and remain solvent. That interest payment needs to be paid off, so that's why we need to make sure that we can do that. Our next port of call is how efficient is the business. So effectively, we can look at, again, as I mentioned earlier, there are all types of efficiency measures. The one we look at here in this class is the inventory turnover. So here we take our cost of goods sold divided by the inventory, and where we have 6 million divided by 1 million, and this is 6 times per year. So effectively, inventory can cycle through the business at a rate of around 6 times per year, which again is a fairly healthy figure. The higher this is, the better. The next is our ability to control our credit accounts. So our ability to control our customers who buy from us on credit. Again, the higher this figure is, the better. So revenue as a whole exceeds accounts receivable by 13.3 times. You compare it to the industry standard, you compare it against yourself a few years ago, but that looks a fairly healthy figure. Okay, so overall interpretation for the business: strong liquidity, impressive net profit margin, impressive return on equity, 25%. This is a good company offering a good return. Relatively high amount of risk because we've got 0.78 ratio of debt to equity. So again, this can account, remember, the more risk, the more return. This can account for that relatively healthy return. So it can be quite vulnerable if there's a major downturn or any other kind of challenge. But the interest coverage ratio tells us that it should be able to weather a regular storm. Maybe not so much in the very worst of storms, but it looks fairly good. And the efficiency ratios tell us really that the company is managing its assets well and it's collecting in on its receivables in a timely manner. So this company appears to be good with strong liquidity, profitability and efficiency. The high debt to equity ratio is a worry, and managers may want to bear in mind different strategies that they could think of to sort of deal with this situation and manage the risk attached to this over time. So there we go. That's our interpretation of this set of accounts using those particular ratios. And if you were to see this in an exam, it would probably just appear just like that. Comment on the characteristics of the company that you see in front of you using the following ratios. Okay, so remember, just always catch those 4 different characteristics: liquidity, profitability, solvency, and efficiency. Okay, thank you, and we will next see you in topic 4.